back to the Capital Mindset Show, guys. We're your hosts, Austin and Fabio, and today we have a special episode. It's a preliminary analysis on Stanley Black Decker Incorporated, ticker symbol SWK. And so this stock, I'm going to be asking Fabio what this stock is, as well as the discounted cash flow. We're going to be plugging it into our discounted cash flow model, and then also some potential industry headwinds or tailwinds. And like always, before we start here today, we encourage all of you watching here today, if you're new, to visit our website at www.capitalmindset.org. Scroll all the way down to the contact us form here, enter your name, your email, and then the stock that you would like us to do a preliminary analysis on or a deep dive analysis on. And as always, we are not registered or licensed financial advisors, so we will not be offering financial advice. However, we would absolutely love to analyze any and all stocks that you guys are potentially interested in. So Fabio, and you know that I'm going to say it right now. What are we looking at here today?
You already introduced the company's name, and basically what I'll go over to kind of showcase exactly what we're looking at is the company. So we'll hear from the horse's mouth. And this is basically what we're looking at. This company, I would consider it a blue chip industrial company, maybe not the highest tier blue chip, but definitely a blue chip. So when I was going through their business, right, because this is a preliminary analysis, and I don't know if you've covered this yet, but we received some flattering comments about some of our preliminary analysis videos, that they're DD, that they're very good DD. Well, actually, it's not DD. And in fact, it maybe shows more that the content creators on YouTube are providing even less than preliminary analysis. So what this is a preliminary analysis video based on the subscriber recommendations. And we do is we kind of shift through them and we see which ones we're interested in doing further research and perhaps adding to our portfolio. So with this company, without further ado, this is kind of like gives us an idea of what they kind of focus on, which is tools and storage, security, and industrial. All right, so this is by far none an industrial company. They make products like tools and other infrastructure stuff. All right, so infrastructure stuff, that's a broad category. We will see exactly what that is down here. But
yeah, I was actually about to ask, what is
stuff?
Infrastructure stuff include? Because stuff is a very broad term. So I was like, hey, it could be anything at this point.
Infrastructure widgets. So yes, we can see here they kind of do. They have different divisions. So Stanley Engineering and Fastening, Cribmaster. You can go on their website and actually read exactly what that is. You can see here that that's a system that the people on the assembly line can use. And then down here, we get into pipeline and services. So oil and gas pipelines, very important infrastructure, which that's part of the infrastructure stuff. And they literally have one called Stanley Infrastructure, right? So they are heavily invested in basically the production side of the United States infrastructure and global infrastructure. So you can think about that when you think about what kind of political bills going on, Austin. The
spending bills,
the spending bills for infrastructure. Yeah. Yes, maybe they're going to stand to benefit from that. So a lot of different tools and different parts of and different parts of the aspects of infrastructure. So you can see here, they got stuff going on with electrical equipment, obviously road buildings, a lot of the stuff we use to excavate, stuff like that. So then we can also see aerospace manufacturing. So it's at the bottom. So I'm assuming that's actually going to be a smaller part of their business, but a decent size of their business nonetheless. And we know that aerospace and defense, or at least aerospace manufacturing, is probably going to be very important going forward as the United States and other countries look to the stars and try to figure out ways to extract value from space travel or space mining, et cetera. So that's already some just quick thoughts that we have about the company. This company is actually very old. Okay, so this company, I believe, was founded in the 1800s. We are probably going to live long enough to see this company turn 200 years old. So,
wow.
Yeah.
So what that tells me, and for those of you who don't know or might be new listening here today, I'm actually quite new to investing myself. I come from an accounting background, so I'm more of an accountant visiting the investment side of things. But more so, I've only been investing for a little while now through Capital Mindset. And basically one of the biggest lessons that I've learned, and we've talked about this in prior videos, Fabio, is the idea of investing being a multi-layered cake. So while financials are important, you want to be taking in multiple other factors. Now, what I'm seeing here, and these are kind of my thoughts looking at this first and foremost, is that this company's existed for a long time. And what that tells me is that the management of this company have responded well, and they've not exactly predicted, but they've adapted well to the changing times, changing industries, changing, in this case, consumer preferences. I don't know if consumer is the right word, but for the sake of what I'm trying to say, I'm sure you understand where I'm going with this. And then also, I would also assume too, there probably is a vested government interest in and of this business itself. I would assume that, but I'm also kind of curious about that too, Fabio. Is there any sort of vested government interest in this specific business that would give them a distinct competitive edge in the industry in which they're operating in?
I mean, I would say that there might be something there, because them being so crucial for providing these products for infrastructure may actually influence that aspect of the business. However, I don't think they're not. Are you saying that they're being given advantages because of their positioning?
Yeah, like maybe they have access to security clearance or something like that, you know?
Perhaps, but I don't think so. Not to the extent something that Lockheed Martin has, for example.
Okay.
Maybe
Yeah,
some
so
minor amounts, or like
okay.
AWS or Palantir, nothing like that. But maybe. So we'll put a maybe, but the maybe means that it shouldn't be that much of a impact on our investment in a positive or negative. So, but we don't know necessarily how good their competitors are in a position compared to them. So maybe that they're in a very unique position, and we'll kind of see that in the numbers, because some of the margins will tell us that if that's the case. But at least for what we know is their position, or what they provide services for, has tailwinds from here on to the end of for the foreseeable future. Because they're not in these niche declining industries. They're in something that's vital for civilization.
Yeah, so, and so that was, oh, sorry, Fabio, go.
No, you're completely good. So you're good.
Okay, so that kind of actually introduces my next question now too, and it's sort of a broad question. More so, would you say that SWK is at the point where they've reached maturity? And then also the second question is, if so, potentially why, which we can verify in the numbers if that might be, or maybe not verify it. And then if they haven't yet, what are some potential industry tailwinds that might eventually allow them to continue this increased growth? Or even then, what are some, like also some potential industry headwinds in this specific industry this company operates in, Fabio?
Well, like I would say that if they're a mature industry, yes, they are in a mature industry. It's not new what they're doing, you know. A lot of the services they provide, they've been doing for quite a long time now. For example, on their website, it says they've been servicing the aerospace manufacturing divisions for like 40 years. So by no means is this an up and coming industry. However, that doesn't mean that there's low growth or perpetually low growth here going forward, or any contraction. There may be a little bit of an acceleration here and there, because some of the sectors that they provide services for, like space again, those are just starting to pick up. But over the past 10 years, this company has grown revenues at about 5.6%. And that's averaged out over the last 10 years in sales. So I actually think we should just hop into the model.
I would also agree too. I think we should definitely do that.
Yeah, and we should start talking about some of the things we find. So let's actually go ahead and put the ticker symbol in, and then let's hop onto the key ratios before we come back to this. So first off, in the key ratios, I'm looking here first at the liquidity ratios. This doesn't look too good, but it's the most conservative portion of that. Okay, so the current ratio, at least they can cover their current liabilities. But
so where my thinking is primed for this right now is they likely have a lot of receivables. That's kind of where I'm going with this, or they have a lot of inventory, or they have, you know, other prepaid expenses, et cetera, and so forth. But I have a hypothesis here that a lot of it is probably on receivables, which we can verify later. But that's just my preliminary thought, just looking at such a discrepancy between the current ratio and the cash ratio, Fabio.
I would agree with you on that. Especially think about the customers that they have. Their customers are a lot of manufacturers who then also use their products to then build an end product. So a
Mhm.
lot of times they may have a lot of accounts receivable. So stuff that they've done the service or provided the product, but they haven't received the cash yet. And they probably have agreements with their customers. So that's where I'm going with this. And we'll probably see that in the activity ratios too. Okay, so debt ratio, stable. This is a very old company. It survived a long time for a reason. Long-term debt ratio also looks pretty stable. It's grown a little bit, but it's pretty stable. I count that stable. So you see it's as an up year, a down year, up year, down year. So we just want to maintain that stability. Long-term debt to capital, again, more or less stable. I'll count that as stable. Debt to equity, stable. Count everything as stable. So everything's kind of remaining the same. Gross profit margin. Okay, here's something. So margins were really high in 2017, and then they're increasing again in 2021. That's good. They had a little bit of a drought on margins on 2019, and then operating margins has been improving drastically. That's a good sign. That's a very good sign. Net profit margins, somewhat improving. I count that as stable because, you know, from 9.4 all the way to just 10.8, stable. Return on assets, that's increased by 100 basis points. That's good. ROE, about 200 basis points, a little less than 200 basis points. That's still good, but a huge increase from 2020 to 2021. We're basically returning to the 2017 numbers. So that's good. So I think for me, nothing really sticks out here. What about you, Austin?
Nothing. I mean, the first place that my thinking would go in this instance is basically to the discrepancy between gross profit margin and operating profit margin. And the reason why my thinking is typically oriented towards there with profitability ratios is because of the fact that if there's a large discrepancy, that tells you that they're expensing a lot of costs in their operating side, whether or not that's selling, general administrative, advertising, et cetera, and so forth. Here, I'm not really exactly seeing such a huge discrepancy. Now, a discrepancy would be something like they have a gross profit margin of like 70%, Fabio, and then suddenly an operating profit margin of like 14%. That would be huge. That would raise a red flag. But here I'm actually seeing, well, sorry, yes, go Fabio.
Yeah, that would raise a red flag in this kind of business. But for example, in a software business, that'd actually be kind of normal.
Interesting.
Yeah,
Okay.
just simply because it depends on the stage at which the software company is in. So if it's early stage or ending its early stage, you would see still a strong discrepancy. But late stage software businesses, like let's use an extreme example, Salesforce. So Salesforce has very good margins across the board. It's a software business by far and foremost. And then as you go down the income statement, you'll start to see that over time, those ratios have improved, but in the beginning, they were terrible. So it's all about scaling that software because in the beginning, they're going to take on a lot of operating costs, but their gross margins are going to be really high because it's software.
So something that's really actually interesting about what you actually said too, is that that's what you just heard come out of my mouth is indicative of a lot of common investing knowledge, which is basically you take one set of circumstances and you broadly apply it to multiple different industries. But what I'm gathering from what you just told me is that in this instance, that would raise a red flag. In the instance of it being a software company, it would not be. So basically the point that I'm trying to say is that depending on the industry, different things are going to matter over other things. And now that sounds so basic and it sounds so intuitive, but I see a lot of people, and I'm also guilty. I just did it, but I also see a lot of people on YouTube too, setting all of these just arbitrary thresholds for every single company, regardless of industry, and then Xing companies based on these respective thresholds. And what I just gained there from you was actually a huge knowledge drop, which is basically, no, it's industry specific, which is also the reason too why, if you watch our other videos, in some industries book value matters, while other industries book value doesn't matter, for lack of a better word. And so that was just an aside. Now we can get back to the company at hand.
No, but those are little nuggets that we will be dropping always in our videos. That's one. And then so now going into the earnings quality, I like this is a unique metric in capital mindset, what we do. So we're we're seeing actually improvements, and I prefer to see anything above 1. So I like what I'm seeing here. I see free cash flows going up nicely, EPS going up nicely. So GAAP EPS, everything looks good in my opinion. Book value per share for this industry, I care a little bit more just because it's in the manufacturing, a lot of PP&E. Okay. So this industry, I'm going to take a little bit more credence to the book value. And our book value calculation is a little bit more conservative than the typical, because we like to remove a lot of intangibles. So
well, actually, oh, sorry, Fabio.
no, continue. Yeah.
Let's kind of actually explain in a brief minute or two what book value per share actually is, because I've not really seen too many good definitions or like good what do you call it, examples of what book value is. And then also too, some other industries where book value actually matters to you, Fabio.
So yeah, book value is basically, if you want to simplify it, it's the value of the business, or the residual value of the business after all liabilities are paid, and what you could presumably or theoretically get if the company were to go bankrupt. So you have to take with a grain of salt, because there's a ton of ways you can calculate book value. Management might calculate book value differently, or as GAAP allows it for, calculate book value differently than maybe you should. For example, the true value of inventory may not be the value of inventory stated on the balance sheet. The balance sheet under GAAP may not accurately be reflecting. And I've had my gripes with GAAP. I've expressed them here. For example, I've expressed it in my China videos on the channel, or my rants in the China videos on the channel, with regards to capital that's stuck in China, American companies with capital stuck in China, and how GAAP does not currently reflect that. So it treats cash the same in either case. And as well as what we're talking about here in book value is the inventory, you have to take that with a grain of salt. So that's for the accountants, right? GAAP can only go so far before you as an investor have to look beyond it. And don't dismiss GAAP entirely. That's not actually what I'm saying, but just understand its weaknesses, right? It's this knight in shining armor, and the knight has weaknesses in the armor, and you got to be aware of them, because otherwise you're going to be too confident going in and building your models, or going in and building your investment assumptions, and then you weren't paying attention to the weakness in your armor, and then that's what did you in, right?
So two questions now, Fabio.
Yeah.
Basically, for some of our new viewers who might not have any idea what GAAP even is, GAAP stands for Generally Accepted Accounting Principles. They're written by FASB, and it's every publicly listed company on the US stock exchange has to adhere to US GAAP. And then the second question that I have for you, and you brought up a very, very interesting point. You said something about the inventory on the balance sheet, and I'm wondering if you could elaborate on that a little bit more. Are you talking about, in this instance, cost flow assumptions, such as first in, first out, last in, first out, average, et cetera, and so forth, Fabio?
That, and sometimes, okay, so like basically when we value our inventory, there's a couple ways we can value that inventory. So depending on which accounting rules you're using, IFRS or GAAP, but essentially that doesn't necessarily mean the true realizable value with whichever method you use, because just as inventory has a price, well, so does like the stocks, right? So stocks have a price any given day, and that can fluctuate depending on a variety of factors. Inventory is similar. So let's say I can sell this pen, all right? This pen costs me a couple pennies, 2 pennies, right? And I go into the market, and I know that right now I can sell it for 10 pennies, right? What should I value this pen at? Should I value it at the 2 pennies it cost me, or should I value it at the 10 cents I can get it in the market? All right, or somewhere in between, right? And then let's say tomorrow, the value of this pen, I try to go sell it. I believed it was 10 cents, and I actually try to go sell it because I'm going bankrupt, and I can only get 1 penny for it. Okay, well, whatever I had written there before, let's say I did it under the assumptions that were reasonable, and I'm not trying to cheat my shareholders. I was genuine with my assumption of 10 cents. But when I tried to go sell it going bankrupt, I could only get 1 cent. Well, who was right? Well, the market was right in the end. The market is the true value of that asset or of that inventory, right? At that given moment, because that's the key, at the given moment of liquidation. Inventory has a value, but you don't know what it will be at the given moment of liquidation.
Yeah.
Right.
So basically, to kind of help, and correct me if I'm wrong here, Fabio. So the way that inventory works is that when you first buy inventory, let's say that I buy this pen that I've been playing with the entire video because it's my favorite pen. Let's say that I buy this pen for $5 and then I want to then sell the pen for $10. Usually the way that it would work is that I would take the sales price, which would go into revenue there. And then I would take this $5 amount of the pen, which would go into the cost of goods sold. That would come into my gross profit of $5. Because I'm taking the sales price that I paid, or like the sales price that I received, and then I'm subtracting the price of the pen, which goes into gross profit. Now, what you're also saying too is basically that at any moment in time in the market itself is that that inventory that you paid $5 for it. Let's say that instead you now sold that inventory for $3. Now what happens? The inventory, despite the fact that you paid $5 for it, now you're now recognizing a loss of $2 on that inventory that you paid for, which is exactly the point that you're saying, whereby at any given point in time, the inventory numbers, regardless of the amount you might have paid for it, will fluctuate. And that's something that you like to keep an eye out on. And that's something that you like to be weary of when it comes to inventory. So now my second question to you, Fabio, is, now, do you add an added layer of scrutiny because of this concept there? Do you add an added layer of scrutiny to businesses that have a tremendous amount of inventory?
Yes. So I do not value it anywhere near what management says it is. Okay. So I'll for the purposes of liquidation, let me be very clear. For the purposes of liquidation, I do not value it at what management believes it is, nor do I like to use too much current ratios that utilize a lot of inventory. That's why we have the cash ratio on there, and we like to observe the cash ratio, because there is another ratio that we can utilize, and it's just simply removing the inventory and keeping accounts receivable. Because if we can assume that everyone's going to pay the bills, we can keep accounts receivable and simply remove the inventory, and then we can get another ratio which tells us a better picture. Because I don't like to assume that management is going to be able to sell the inventory for what they say they will. And it depends on like what kind of the business is, because let's say it's iPhones, and let's say in this crazy world, Apple goes bankrupt. Well, what is the value of those iPhones left on inventory if they were trying to liquidate everything? Well, probably not nearly as much as you'd think, because now a lot of implications come to play. Well, who's going to support the software going forward on the iOS, right? So there's a lot of other things you got to think about, that maybe those iPhones are not going to be the same value. And also the iPhones on inventory now are going to be worth less in the future, right? So the iPhone 8 cost them whatever to make, but the sales price that they're reasonably able to get for that iPhone 8 goes down next year, and then the year after that, and the year after that. And today you can buy an iPhone 8 for not that much. And now, the iPhone 13s came out. So now the iPhone 12 is now value less. So with all that being said, that's the snippet that we're talking about with inventory. Does that answer all the questions, Austin?
Yes, it does. And now let's bring it back here for our audience to Stanley Black and Decker Inc. into this discounted cash flow model here. We are stopping back at the key ratio side. We just took a look at the book value per share, which launched into the whole inventory. The whole enchilada about inventory. And now, would this be a company where activity ratios would matter to you, Fabio? Yes.
Yes.
Okay.
Yes, because they're selling products. So if they're selling products, I want to see what's going on in there. So right here, we can see that this has been getting a little bit worse, but that coincides with what we were discussing, that they probably have a lot of accounts receivable. So right there, a lot of accounts receivable. Inventory turnover, everything seems okay. So this is getting worse. This is getting worse. Okay,
Fabio, if I may cut in here for just a quick second, just to let our audience know, if you don't know what accounts receivable are, what happens is when two parties enter into a transaction, okay, and there isn't physical cash exchanged, then one party is saying, I will pay you this amount at X date. Now that transaction, that oral contract or written contract, that contract is then booked into accounts receivable. Now, Accounts receivable, and the reason why Fabio and I are sometimes weary about accounts receivable is that accounts receivable comes with also what's known as collection risk, which basically the bad debt expense would go into the income statement if they can't collect on these accounts receivable. So just in case our audience was not aware of what accounts receivable are, now, Fabio, do you have any other nuggets of knowledge you can offer regarding accounts receivable as well, sort of from an investing perspective, aside from the accounting terminology of what accounts receivable is?
Oh yeah, you actually want to be careful with the nuance of accounts receivable. So for example, there have been times in the past where certain companies, we might do separate videos on these companies because they're interesting case studies for fraud, but
Yes.
they would give a ton of credit to their customers and sell a bunch of products to their customers at whatever prices, and they'd be also lending them the money to do so. And so their accounts receivable would be really high, and they would record a ton of revenue, but they haven't received the cash yet. So those sales would be going down into their income statement, their GAAP income statement. And again, you see the limitations of GAAP. It allows for some of these instances, and it's not necessarily fraud. And actually, there's an industry that does this very, very heavily. I'll just say it: the automobile industry does this a lot today. So if you see, like, for example, General Motors, Ford, I think even Tesla's, beginning to this because it's natural for the automobile industry. I go to the dealership. Let's say I go to the dealership today and I want to buy a car, and I didn't come with a loan ahead of time, so I might borrow money from the banks within the auto manufacturer. And if you go on the auto manufacturer, you see the debt portion. The debt portion, it's really high, right? But that's not because they borrowed a lot of money. It's actually because that's a lot of money they kind of lent out. So you can kind of see then on the accounts receivable, it kind of more or less matches to some degree. So yeah, so when you look at like what's considered the real debt, when you go into the 10Ks of the automobile manufacturers, you'll see that. And that's an example of when it's not necessarily fraudulent, but there are industries and companies that have done it in a fraudulent manner, basically where they knew these companies would never really pay them, but they lent it out and they had high accounts receivable and they never really got that cash. And next thing you know, they're going bankrupt. So with this industry, I actually think a growth rate of between 5% and on the high end, 10% is fairly reasonable. All right. And then let's move the 10% over here and let's go a little more bullish at 15%. But I don't think they're going to get to 15. I think
also, yeah, sorry, Fabio, go.
No, I don't think they're going to just get to 15. I think that they're going to more or less stay within this range, 5 to 10. So any comments, concerns, Austin, so far?
Yeah, I've noticed that enterprise value is more than their market cap right there, which if you watched a video a couple of days ago now, or a couple of videos ago, we actually talked about some of the things to watch out for if enterprise value is more than market cap. And because, correct me if I'm wrong, Fabio, enterprise value takes out the cash out of the market cap and then adds the debt back to that.
Yep.
So basically what we're looking at here is a company where the enterprise value is more than the market cap. Now, would you shed some light on that, Fabio, as to what the potential implications of this might be?
Well, it's not necessarily a bad thing. It's more like a smell test. So you really kind of just quickly glance at it and you can say, okay, they have their net cash position is negative, meaning they owe more money than they have cash on the balance sheet. So that's not necessarily a bad thing because they may have the cash flows to support that debt. And I'm pretty sure they do. If we take a look at the Altman Z-score, yep. So the Altman Z-score is looking good, which for this business, this is what the Altman Z-score was designed for, which industrial companies, and above a 2.7 is very good. So they're not at risk of bankruptcy or anything like that. So what I'm seeing here is on a free cash flow basis, this is more or less moderately priced, okay, fairly priced, in line with the historical average multiples of the S&P 500. So for the United States, that is a fair price. So it's fairly valued, basically. And what the problem with this company is, they've been quite dilutive over time. And you can see that in the average buybacks over the past 5 years, it's actually negative 1.46%. So they've been diluting you. And if we kind of take a look at some of the dividends, right? They're paying a dividend yield of 1.57%. So each time they issue new shares, they're actually increasing this obligation as long as they continue to pay that dividend. And typically when companies pay dividends, they don't like to cut them too much because their shareholder base kind of becomes accustomed to the dividend. And the dividends become a huge part of the returns over time, or the returns assumptions over time. So if I assume I'm going to add back this dividend, it actually becomes a small little buyback of 0.17%. And in that case, it's a very small buyback. So I'm just barely not getting diluted based on my previous assumption, right? I assumed 1.4, not negative 1.46. So I assumed a little less dilution in terms of shares. But if I reinvest my dividends and the dividend yield remains around here, I will keep around, or no, I will increase my ownership stake by 0.17% each year. And then you're making that 15% assumption. But I'm not even discounting this heavily. So if you discount this at the market average return, then you're starting to see some possibilities of this making sense. I think that this is going to be like a, yeah, so it's not even 12%. It's not, for me, this business needs to come down. Personally, for me to start getting interested in this business. So I'm going to X this company. I think it's a good business. I do think it's somewhat of a blue chip, but I need to see the price come down for me to actually get interested in buying this business. And we had a moment where it was possible to get this price. So first, I actually
exactly what you're looking at. When it hit roughly around $173 a share back in like the mid-October of 2021.
Yeah, so it was just more recently. And what did it hit during March 2020?
It hit. Oh wow. Hello.
Share your screen with us, Austin.
Sure thing.
Show the audience what you're seeing and highlight that.
Yes, I shall. Okay, so here's kind of what I'm looking at here. And we're seeing it go all the way down to $78 in March of 2020. Fabio.
You see right there, if I take the screen back from you, go back to the model for our audience, I can probably discount at 20%. Yes, I can. That would have been the time to buy. Wow. So
hindsight's always
hindsight, yeah.
In this instance.
Well, I mean, but we've done videos where we showcase some of our positions. We've done a video on ACI, one of your positions, one of my wife's positions, and we showcased how the model was telling us to buy. We bought, and then the run up happened, and now you already did a video, and we're going to actually post that video, or it should have already been posted. That you kind of were thinking about adding or not adding, but you're kind of like looking at another preliminary of ACI. But that the model was telling us based on the assumptions that we had a decent margin of safety on these businesses. So this one, if we knew about this business back then, it would have been an interesting buy.
Yeah. Well, I mean, I haven't even entirely X'd this business yet either, Fabio. The reason for that is because this is a business that's existed for a long time. And I do believe that the way it's positioning itself in its industry, it could exist for a long time after us. Now, the thing is that I would be interested in this business should the price come down again.
Yeah,
I do. I would corroborate that at the moment, the price that it's trading at on today's date is too much. And the reason why too, and I've kind of explained this in other videos, is the fact that when it comes to growth rates, what we do is we typically take our discount rate, we take the market average, and then we add a margin of safety onto that, which is why the 20% here that you're seeing for our required rate of return is a 100% margin of safety, which means that should our assumptions prove to be wrong, we could still get out okay with the price that we specifically paid for this specific stock. Now, I like to take this, Fabio as well, correct me if I'm wrong. I like to take this one step further, and I actually like to apply the same margin of safety concept to the growth rate and cash flows. So during a DD, if I was to do further due diligence into this stock, I would come up with a set of assumptions by which I could reasonably believe that these cash flows could grow at this rate over the next 10 years. And then still, I would still require that margin of safety within those growth rates. So for example, let's say that I believed that these cash flows could grow over the next 10 years at the rate of 10%. I would still, if the model returned to me at a 20% required rate of return, a 5% growth rate, and it still returned to me a favorable buy price, then I would consider, me personally, I would consider making that investment, because that satisfies my my margin of safety requirements whenever I'm about to make investments, because we're humans. We don't know every single possible thing, which is exactly the reason why I like to take comfort in knowing that the price that it's returning, the favorable price that it's returning, is still within the grounds that I could still be wrong and still come out ahead, as I like to call it. So.
Yep. No, I completely agree with that.
Yeah. Wonderful. Well, Fabio, do you have any closing thoughts regarding this company?
Well, simply that I like the business. I'm going to wait for it to come down. If it were to come down, then I would take a second look at it and then consider adding it to my portfolio. At current prices, a complete agreement. Not for
Yes.
me at the moment.
I would probably say the same thing, that it's not for me at this present time, but should the price come down, then we can reconsider. Well, folks, you've heard it here first. If you guys have liked what you've seen here today, please be sure to share the video. It really helps out our channel. Please be sure to visit our website at capitalmindset.org and comment any thoughts, suggestions, critiques, even. Subscribe to our channel. We're your hosts, Austin and Fabio, and we look forward to seeing you guys again. Take care.